Good morning. Thank you for joining us today. This is Tara Sewell, Internal Wholesaler. Today is our FMI Summer Giveaway, and we will also welcome a guest speaker from Prudential. Your lines are muted for sound quality. If you have questions after the webinar, please reach out to your internal wholesaler. First and foremost, thank you. We truly appreciate your partnership and your business. Together, we are making a meaningful impact, protecting families, securing financial futures, and preserving legacies. Congratulations to Cliff. He was our March Madness giveaway winner. He won a smart TV. Our runners-up each received a $50 gift card. Thank you for your business. Today, luck is on your side. We have 5,847 tickets in the hat, and they've been thoroughly shuffled. Anything can happen. One advisor on the call today will have their choice between a stainless steel smokeless solo stove or a Galaxy Watch 7 or Apple Watch Series 10. 4 runners-up will each receive a $50 Amazon gift card. In order to win, you must have earned tickets, be pre-registered with your full name, and be present on this webinar for the duration. And remember, your name can only be drawn once. Before we get to our drawing, we have a special guest from Prudential's Advanced Planning Group. This group consists of a team of attorneys and consultants who provide guidance on estate planning, business planning, wealth distribution, and tax planning using both annuities and life insurance. I would like to introduce our guest speaker, Chuck Perrault, Vice President of Advanced Planning. Chuck?
Great, thanks, Tara. Thanks, everyone, for taking some time out of your day and spending it with us here. Hopefully what you'll leave with is an actionable idea that can really be something that we find opportunities for almost immediately. The presentation we're doing today is called Mirrored Loans, Basics and Beyond. And what we always start with when we're having any kind of conversation like this is policy review. And I know that policy review is sort of a kind of a common idea, right? I think it's maybe one of the first things we all learn when we are getting into this industry and learning about what an opportunity looks like, right? Does their old policy fit? Is there something better about a new policy that could improve their situation? But my experience, and I imagine most of your all experience as well, would be there's one big subsection of policy reviews that most advisors don't feel comfortable with, and that is when these policies have a loan on them. When I do this presentation in person, I always ask everybody to raise their hands if they've ever come across a policy with a loan. Inevitably, everybody's hand goes up. Then I ask everybody to keep their hand raised if they felt comfortable knowing what they could and couldn't do with that policy. And the overwhelming majority of the time, every single hand goes down, and maybe you get a straggler or two who feel comfortable, but I think that illustrates the point pretty well, which is we've all seen these types of cases, but industry-wide, there is a lack of confidence, a lack of comfortability with how to deal with these cases. And if you look at how much of policies out there exist with loans, we can see kind of the issue. Just at the 5 carriers you see on the screen, there's $56 billion of policy loans outstanding. And I think this slide's a year or two old, and we have an updated version somewhere where I believe it's over 60 billion with just these 5 carriers. And which if there was no loan to any other carrier would already be a pretty significant opportunity, right? But we know there are a lot of carriers out there that have policies, and all those policies could have loans on them. And there's a lot of carriers out there that maybe we don't think of anymore, right? That don't sell policies today, but still have a pretty significant book of business. I started my career at MetLife. MetLife looks a lot, or used to look a lot like the names that you see on the screen here. And while they don't really exist anywhere near the same way anymore, they very much have a significant book of business still out there that I imagine would mirror a lot of what we see at these carriers. And there's any number of similar examples, right? So we have $60 billion or so of policy loans between just these couple names, it stands to reason that there must be several $100 million across all of the carriers. So what we're hoping to go through today is really the first two sections, and we'll touch on the third if we end up having some time. But what is the issue, right? Well, why are these policies so unique, and why aren't people comfortable? And then we're going to really spend most of our time talking about how we look at and deal with cases. And again, if we have some time at the end, we'll go into a few bonus ideas. So let's start with what the issue is. And to understand the issue, you have to understand the problem. There's two ways a loan can end up on a client's policy. The first is maybe the real obvious one. If you've ever put a policy with cash value in front of a client or a prospect, you probably asked how they could use that cash value, and you probably told them some version of that they had access to that money if they needed it. Now, I don't know if that's any more frequent on any one policy type than any others, right? I think if our client needs to fix their roof, they're glad they have cash value in a policy if that's the best place for them to get it. So I imagine that happens with somewhat similar frequency across all policy types. Whole life policies, though, have one unique feature in this regard, which is they can get loans without people realizing it's happening. Generally, on a whole life policy, that premium is required to be paid every single year. And if that premium is not paid out of pocket by the client, the policy will usually go on what's called automatic premium loan, and it will actually take a loan from the policy and use that loan to pay the premium. So it would stand to reason, since there's just more ways to get loans on whole life policies, there probably are more loans on whole life policies. And I think that slide, a few slides back with all the different numbers, would largely agree with that sentiment. Now, in and of itself, having a loan isn't a devastating problem, but you do have to understand the long-term implications, right? If we just took a loan, fixed whatever short-term problem we had and paid that loan back in reasonably short order, it really would have very minimal impact on the longevity of our policy. If we take a loan, though, and it just sits there, that can have some long-term implications, right? Many of these contracts have really high loan interest rates. It's very common to see 6, 7, 8% loan interest rates on an old contract. And so if that loan sits there, it's just going to grow and grow and grow. And oftentimes, one loan is just the start, right? Maybe they miss another premium, take another loan. Maybe they have another problem, they take another loan from the contract. And long term, certainly this is going to increase their cost, right? Accruing a bunch of interest and taking a bunch of loans and missing premiums, none of that does anything helpful, obviously, right? But the long term of that is not just that it can increase the cost to keep that coverage in force, it's that it can actually cause that policy to lapse. And some of our clients look at this and say, well, I actually don't care if it lapses. Maybe I'm a bit older now. I have passed the point in my life where I am concerned about having life insurance coverage. So you know what, just let it lapse. And the tough part is when a policy lapses with a loan against it, that loan is considered phantom income, which means it's taxable to the extent of the gain in the contract. So a lot of times clients find themselves in a situation where they're sort of damned if they do and damned if they don't. They can either pay the new higher premium to keep their coverage in force, or they can let it lapse and have to owe a bunch of taxes. So whenever we look at one of these cases, we try and take people through three options. There's really four, right? At any point in time, the client could always write a check and pay their loan back, or nothing is stopping them from doing that. If it's that easy for them to do that, no one is probably calling us, right? So we tend not to spend much time in that option, but again, that is one that's available to them if it does make some sense for them to do that. The three options we look at are effectively do nothing, fixing your old policy, and fixing your problem with a new policy. You should always start with, here's what happens if you continue down the course you're on, right? Whether that means you're not paying premium or whatever it is that you're doing, here's what will happen. A lot of times that means their contract will lapse and they'll owe a bunch of taxes. So doing nothing might actually mean that they owe a significant amount of taxable gain. But they need to understand that, right? A lot of times when we're talking about all of these options, they may not love any of them, but it becomes a battle of which one of them is the least expensive. And letting your policy lapse and paying a bunch of taxes is a real cost, just a different cost than paying a premium or paying some loan interest. They could change their approach. What I really mean by that is probably put some money towards their old contract, right? So in some way, try and fix the problem they have with the policy they have. That can work, right? You should run and request the best possible in-force illustration to solve whatever the specific problem that you have, that your client has on these types of cases, right? I encourage everybody to do that. If you're going to replace a contract, you should make sure that the new contract is better than the old one. And we can only know if the old one is any good if we have an in-force showing what we're trying to accomplish. Now, where Prudential fits in, where we can see opportunities and hopefully generate some cases for this group, is to look at a new policy to fix their problem. In that new policy, what we will typically do is execute a 1035 exchange and bring that loan over to the new contract as part of that exchange. Now, you might be thinking, well, how does that help, right? If we have a loan on our old contract and now we just have a loan on a new contract, how are they in a better spot, right? I mean, we have a new contract. We have to pay new charges. There's a new surrender charge period, probably, right? I mean, these are all real considerations anytime you do any 1035 exchange. So why would this ever work out better for one of your clients? Well, there's a couple of reasons. First and foremost, we typically have a much lower loan interest rate. Most of our contracts at this point have a 2% loan interest rate for the first 10 years, and that interest rate contractually drops to 1.05 starting in year 11. All of that is fixed, guaranteed, cannot change. Again, that's the loan rate across most of our contracts. There's a couple that haven't been looked at and repriced in a while that are a little bit higher, but even on those, it's typically still considerably less loan interest than they're paying on their old contract. So that's good, right? Paying less is better than paying more when it comes to interest. But in and of itself, that's actually probably not enough reason to do the exchange, right? There's a lot more to consider than just the interest rate on a contract. The real reason that we're able to find a lot of opportunity is as with any other 1035 exchange, we get to redesign the problem, right? We get to structure their new policy to do whatever it is their goal is today, instead of whatever it is their goal was yesterday. I don't imagine any of you on this call have ever done a 1035 where you paid exactly the same premium for exactly the same death benefit on the new contract. I'm not saying there's no reason you would ever do that, but that's just not usually what we're doing, right? We're trying to get more death benefit or save them some money or do something that's caused their situation to change and they have a different goal today. Same is true with these loan cases. Their old contract likely never considered being in the situation that they were in, right? They probably never saw an illustration when they started that said, hey, you know what? Finances got tough. We missed some premiums. The contract maybe underperformed a little bit. And I had to borrow money unexpectedly from my policy for this issue I could not possibly have anticipated 30 years ago when I bought it. So it would stand to reason that our old contract, which never anticipated being in this situation, may not be as good of a solution as a new contract that's designed solely to solve this specific problem. We were also given a good guy a couple of years ago with the changes to 7702. Now, if you heard anybody talk about these changes a few years ago, what they probably talked about was a LERP case, right? 7702 said you could buy less death benefit for the same premium or put more premium in for the same death benefit, and all those max funded type of income sales that you looked at got better. It really actually affected these cases too. It allows us to buy less death benefit now per dollar of 1035 that comes over. Now, you might not know this because that's almost never the goal. But in these cases, it can be the goal. On a really highly loaned case, by being able to buy less death benefit, we can actually do a 1035 of more highly loaned contracts than we ever could prior to these changes. To that end, we can look at cases today where the loan exceeds 90% of the total cash value that's coming over. That is as much or more really than any other carrier that's out there. We do have one main rule, and that is that you have to have at least $25,000 in your old contract that is not loaned out. Again, at least $25,000 in your old contract that's not loaned out. You may notice I keep saying at least 25,000. You need at least 25,000 because sometimes 25,000 is not going to be enough. As you start to deal with larger and larger and larger exchanges, $25,000 may not be enough to put a larger face amount that would be required with the larger exchange in force. So as the 1035s get bigger, it's somewhere around 90% of that cash value being loaned out is really the maximum that we can look at. Well, once you get beyond that, you literally don't have enough money left in the old contract to start the new contract. That being said, again, as I mentioned a moment ago, that exceeds really any of our competition out there. We can do this on any product. We don't have any product restrictions, though as you might expect, not every product is equally good at solving this specific problem. So if you have a specific goal or product you'd like to use, we can certainly try. If it makes sense, great. If not, we may be able to show you an alternative on a different product that works a little bit better for these types of cases. And I want to touch for a moment on our results. I don't know that you should care how much business that Prudential does for any reason other than what it means to you personally. What it means to you personally, and the fact that we've placed thousands of these cases, and these numbers are a couple of years old. It's something like 3,000 cases placed at this point, somewhere closing in on $1 billion of 1035 with loans. The reason that you should care about that is because we have experience with these cases. Most of the advisors that we work with have never worked on one of these cases before. They've never done 1035 with a loan. And naturally, if that's the case, you may not be very comfortable with it. We are. Every time I say I've seen everything, I get some new unusual thing, but I mean, we've seen just about everything at this point. We're happy to spend as much time as you need to have those conversations to make sure that when you're out there having the conversation with the client, you know why we did what we did, how it works, and everything about our solution, because ultimately you guys have the hard job here, right? You have to demonstrate to a client that this does or doesn't make sense to help their situation. So let's talk about the cases. I break down the cases by how loaned out they are. Generally, we can group cases this way because they typically will have similar goals, but every case is unique. You know, one of the biggest questions I always ask is, what are you hoping happens here? We will do our best to try and accommodate whatever your goal is. The more you can tell us upfront about what you hope the solution will look like, the quicker we're going to get to the right place in terms of a solution. Let's start with policies that are not that loaned out. When I say policies that are not that loaned out, in my world, that means when less than half of the value is loaned out. And maybe even at this point, 60% of the value or less is still not a heavily loaned contract in terms of the design. A lot of times clients just got here by having those automatic premium loans. Maybe they had that small unexpected house expense or whatever it might be. But these contracts are not the ones that are keeping people up at night, right? If you have a 30% of your cash value loaned out, your policy's not lapsing tomorrow. It might not even lapse long term, but it might. In long term, those loans are not going to do anything helpful. So long term, there's some policy viability issues whenever we start to see loans. So when we're looking at a new contract here, I would tell you this process looks a lot like every other 1035 you've ever done. I want to know everything that you want to know on any other exchange that you've done, right? Do they want to pay a certain premium? Is there a certain death benefit we're trying to get? Is there a rider they care about? Whatever you care about on any other case, we care about on these ones that are not that loaned out. The one unique and cool thing here, though, is how we handle the loan. A lot of times on our solution, we'll show a withdrawal of the surrender value of that contract to repay the loan if we have enough cost basis to do so. What that can lead to is a really appealing scenario for some of these cases where the client's loan no longer exists going forward, but they didn't actually write a check to do so. It's a really cool solution. It's really compelling. Most of our clients want to see us eliminate the loan if we can. And frankly, they're not even ever expecting it, right? They've never seen anything like this. But all we're really using is taking a withdrawal of that client's cost basis and using that withdrawal to repay the loan on the new contract. It's something we do on, again, almost every one of these cases, and can provide a really neat, clean solution when we are able to do it. Most of the time, when the loan is less than half of the value, we can do it, and they have enough cost basis to do it. As you can imagine, in the grand scheme of challenging life insurance conversations, being able to maybe save them some money or get a larger death benefit and eliminate debt on their contract at the same time is certainly not the hardest one that you're ever going to have. Where I tend to spend most of my personal time at this point is on the more highly loaned cases. And more highly loaned to me is when really 3/4 of the value is loaned out. You might notice that we don't kind of highlight that in between 50–60% loaned out. Those cases tend to be a little bit of a mix of all of this. So I don't call them out specifically because there's less commonly a similar goal. For these cases that are kind of 75+% loaned out, some of these cases are going to lapse. In some cases, they have to put money in because they're so loaned out. They have to put money in to keep it in force long enough to get them through the application and underwriting process. That's truly a thing that we've had happen. The concern here is the concern I mentioned earlier. It's going to lapse, they're going to have that taxable event, and it's often very expensive to keep these old contracts in force, largely due to those high loan interest rates. So when we look at a solution here, our solution is death. We are trying to not be funny here, right? We are trying to give the client a policy that they can die with as inexpensively as they possibly can, right? Typically, clients whose policies are highly loaned have gotten into this situation by not spending much money. They're going to want to get out of the situation the same way if it's possible. So a lot of times on these, we will minimize the death benefit, we'll minimize the outlay from the clients, and we're able to do that usually in a really meaningful way because of our low loan interest rates. And we're going to keep the death benefit in force long-term, something that they can feel comfortable will be there safely so that they can die with it. And ultimately, when they die, that loan will get repaid and their family will get the remainder of the death benefit that was not loaned out. It may not sound like a sexy solution, but a lot of times on these highly loaned contracts, there really is no practical way for them, or certainly no desire for the client to write checks large enough that would ever get the loan repaid during their lifetime. If that's the case and they can't or won't do it, then we have to solve it a different way. And the way we solve that is managing the policy along so that they die with it, hopefully in a less expensive way than with their old contract. If you lay these solutions out, here's the tax bill, here's your old policy, and here's your new policy, the solution will not always be true, but it is almost always obvious. We will win a fair amount of those cases, but typically if you lay it out that way, the solution of which thing the client should do is pretty apparent to everybody. So what do we need to run a proposal? We need some of the stuff you think we need, right? We need the client information, we need the surrender value, loan value. We really need the cost basis. If you don't have the cost basis, that's okay. We will run something without it, but you are going to need to get it somewhere along the way because a lot of our solutions depend on it. If we're going to take a withdrawal to repay the loan, we need the cost basis to make sure that withdrawal is not taxable. If we're going to tell the client they're going to have a tax bill and that's why they should do this instead, you need the cost basis to determine the tax bill. So really important step, really important piece of information that you may not be used to asking for, but it is very important on these cases. We don't need an in-force ledger, but you probably do. Again, as I said earlier, if you're going to replace an in-force contract, you probably need to make sure the new one's better. I don't know how you could do that without having something to compare it to. The reason I have it on here, though, is because we're happy to have it. We're happy to use it as a comparison, try and show you where our solution is superior. And a lot of times we found we're pointing out things on an in-force that people aren't expecting or maybe didn't see because most clients and most advisors are not used to looking at in-forces with policy loans on them. Last but not least, what's the goal, right? What are you hoping happens here? I know I mentioned that earlier, but I can't tell you how many requests I get where somebody doesn't have a goal. I will always send it back and say, what do you hope happens, right? Anything you give us is great, but I don't know what the client wants or what expectations you've set until you share them. We do have a great piece that attaches right to our illustrations to help us show what's going on with these cases, right? It's specific to this mirrored loan concept. The first couple of pages function as a client approved marketing piece that talk about a lot of what you've heard me say here today. And we do have Life Insight. That's our proprietary policy management tool. This helps us manage and administer a lot of these contracts. It really functions as a much better, more in-depth in-force for a lot of these more involved situations. So I want to wrap up here and be respectful of everyone's time. We have a number of marketing pieces on this. We have broker approved pieces, client approved pieces, you name it, we have it. I know there's some links to pieces here that you guys have access to, a lot of these as well. But I always end this presentation with this. If you're like every other group that I've ever spoken to, you've come across these cases, right? You have them, and maybe you didn't feel super comfortable knowing that there even was an opportunity with these cases. That's okay. If you have these cases in your book of business, if they're sitting there in your filing cabinet, work with Tara, work with the rest of the team, and they'll work with us to see if there is an opportunity. I promise a lot of these cases turn into real opportunities, and in some cases they're the biggest case an advisor has done in a given year. And the worst thing that comes out and happens is you say, hey, you know what, my client really does have the best policy for their scenario, for this specific situation. But hopefully even through that, you'll learn a little bit about what makes a good and bad opportunity with these cases for your other clients. So Tara, I'm gonna stop there. I'm gonna turn it back over to you.
Thank you, Chuck. One thing that really stood out with me is that the amount that in outstanding policy loans with those national carriers. I think the slide said 56 billion, but possibly closer to 60 billion. That's a lot of opportunity. And like Chuck said, opportunities like these begin with a policy review. We here at Financial Markets, we're here to help you determine if a mirrored loan is the best solution for your clients with those outstanding loans. Please reach out to your internal wholesaler on your next case. In your GoToWebinar panel, you will find the 4 handouts on mirrored loans. You can download them now, or you can request them from your internal wholesaler. Now let's move on to our drawing. We're going to draw our first 2 finalists. Let me pull up my hat here. And our hat has been shuffling. Again, 5,847 tickets in the hat. We'll give it one last shuffle and drop these tickets in the hat. We are going to draw our first 2 finalists. Chris Gullickson with 156 tickets. Is Chris on the call?
I'll take a look here, Tara. And Chris is not on the call.
All right, again, you do have to be on the call to be a finalist. We're going to draw, and we're looking for our first finalist. Katie Johnson with 315 tickets. Is Katie on today's call?
We have a Katie, but not Katie Johnston.
Okay, again, have to be on the call. In order to be a finalist, we are looking for our first finalist, Kirby Bowden, 203 tickets. Is Kirby on the call?
Looks like the name that begins with a K is pretty popular here. Kirby is on the call.
Congratulations, Kirby. You are our first finalist. And we're looking for our second finalist now. And we drew Kirby again. It's a K day. All these K names. Looking for our second finalist, Jared Hinkleman with 54 tickets. Is Jared on the call?
And Jared is on the call.
Congratulations, Jared. You are our second finalist. Now, we've been talking about policy reviews. Now, policy reviews, we know, are a proven strategy to uncover new business. Just over a year ago, Financial Markets partnered with Proformix to bring you a monthly business opportunity report. This report provides in-force information from 20 of our carriers. The first page shows you birthdays that are coming in the next 3 months. This gives you time to prepare an email or put pen to paper and mail a birthday card. The next sections are key to policy reviews. This section here shows you which policies have a conversion privilege that will be expiring in the next year. The report also shows which clients have an anniversary in the next 3 months. This is the time to schedule those policy reviews. And during the policy review meeting, you can uncover details on in-force business, including policy loans. The next section shows upcoming policy premium due dates and shows you who will be paying renewal premiums. And lastly, in this sample report, this last section shows potential life settlement cases. A good rule of thumb in identifying life settlement cases is that the policy is no longer needed, no longer desired, or no longer affordable. Your July Business Opportunity Report was emailed to you last week. Reach out to your internal wholesaler if you need conversion options or if you have a potential life settlement case. Let's move on to our next 2 finalists. So far, our finalists are Kirby Bowden, Jared Hinkleman. We're looking for our 3rd finalist, Angie Ford with 90 tickets. Is Angie on the call?
And Angie is on the call.
Congratulations, Angie. You are our 3rd finalist. And for our 4th finalist, Jacob Messer with 58 tickets. Is Jacob on the call?
Jacob is on the call.
All right, we have 4 finalists, folks. We've got Kirby Bowden, Jared Hinkleman, Angie Ford, and Jacob Messer so far. You can reduce not in good order applications and elevate your productivity by submitting e-applications. Annuity e-apps are now available through Firelight on our website, fmiAgent.com. On the website, you will hover over Advisor Tools, click on Forms and Applications, FMI Firelight, then start a new application. Anything in Firelight that is a required field is marked red. Reach out to your internal wholesaler. We'd love to help you streamline your annuity sales. And now, our 5th finalist. Pull up our hat again. We're looking for our 5th finalist. Cliff Cross with 57 tickets. Cliff on the call today.
Cliff is on the call.
Congratulations, Cliff. So we have our 5 finalists, Kirby Bowden, Jared Hinkleman, Angie Ford, Jacob Messer, and Cliff Cross. Neil, how about you tell us about our next cruise?
Let's do it. Yeah. Well, congratulations to the 5 finalists here. I see a couple of familiar names there and some new ones as well. So thank you for your business qualifying you in the drawing today. Hey guys, with as little as $1 million of annuity premium or 30,000 of life insurance premium or any combination thereof, you and your guest could be on your way to the next amazing FMI Agent Point Awards trip. We'll have an unforgettable cruise up the Pacific coast aboard the magnificent Royal Caribbean Serenade of the Seas. It's going to be Tuesday, May 5th, 2026 through Sunday, May 10th, 2026. Immerse yourself in the natural beauty of the Pacific coast while enjoying gourmet cuisine or relaxing by the pool. We're going to set sail from Los Angeles. We're going to visit Seattle's Space Needle for a 360 view of the city. You can also explore historic landmarks in Victoria, British Columbia, and enjoy the picturesque Bouchard Gardens in Vancouver. So we look forward to hosting you on another great cruise.
Thank you, Neil. So our fall giveaway has officially begun. For every application you submit between July 7th through October 3rd, you will earn tickets for our live drawing on October 9th. You will receive 1 ticket for every application submitted, for every 1,000 in anticipated commissionable annuity premium or 1,000 commissionable annuity, life premium. You will receive double tickets for every application with our premier carriers and triple tickets for every case that's placed by October 3rd. Good luck in our fall giveaway. Our winner will have the choice of a PlayStation 5 gaming console or a Meta Quest 3 virtual reality headset or a locking gun safe. Now let's draw our winner. Got our 5 finalists shuffling here. We will drop them in our hat. And our winner is Cliff Cross. Congratulations, Cliff. We will contact you for your choice of a stainless steel smokeless solo stove or the Galaxy Watch 7 or Apple Watch Series 10. Our 4 runners-up will each receive a $50 Amazon gift card. Thank you for spending time with us today. Thank you for your business. Your partnership and loyalty means the world to us. We're grateful to be on this journey with you, supporting families and building legacies. Until next time, take care and have a beautiful day.